Okay, we are going live here in 1 second. Get a little music. Hope everyone's week has been going well so far. We're going to talk about the biggest stories once again. All right, cool. So today is July 23rd, 2021, and we have a lot of stories to cover this week in the world of finance, in the world of Bitcoin. But I want to stress a little bit that there's a bit of a theme to some of the stuff that we're going to cover today, and that is to take the bigger picture view, the macro view on everything. And I'm going to do my best to kind of explain a few macro concepts more so at the end of this video. But a lot of the stories around today have to do with people's fear in the markets right now, and whether that's in the stock market or whether that's in Bitcoin, and what kind of some of these metrics are telling us about investor sentiment in the micro, in the small time frames, versus what the bigger picture story actually is, and how it's really important to differentiate between those two things and not get caught up in the minutia of day-to-day headlines. I know this whole show is about day-to-day to week-to-week headlines, but again, try to keep the bigger perspective on all of these things, because when it comes to making investment decisions, knowing the bigger picture is always going to benefit you much more in the long run. So, without further ado, today we are going to talk about fear as the first thing in the markets. So, I wanted to cover this here. Ooh, am I all good? Yeah, I'm all good. Cool. I wanted to talk about fear in the markets this week because it was brought up on Monday and Tuesday that we are at a record in the fear and greed index. And I'll just share my screen here really quick as to what that is. But essentially, the fear and greed index measures investor sentiment in the markets using a couple of factors. It uses the moving average of the S&P 500 and how high above it or below it that we are. It uses the ratio of junk bond demand, so how many people are requesting junk bonds versus high-yielding government bonds. Market volatility using the VIX, the measurement of fear basically in the market, how many people are buying puts and hedging risk. Safe haven demand, are stocks outperforming bonds this week, vice versa. Put and call options, are more people shorting the market through leveraged tools and instruments, or are more people thinking it's going to go higher? Stock price strength, how many stocks are hitting their 52-week highs versus not hitting their 52-week highs or hitting their lows. And the stock price breadth, how much volume there is in the market, and is a lot of liquidity being pumped into the market. Now, a couple of things that I've learned from the market, from investing in it for a while, is that unlike a lot of smaller speculative markets, the entirety of the stock market does not need volume to keep going up. It needs liquidity, but when you look at a volume chart and you say, oh, the S&P 500 had this many shares traded, volume can decline sharply and things can just keep, just stair-stepping higher. High volume is really needed to bring prices lower. So fear is really measured in capitulation in the general stock market. It's measured in capitulation in the crypto market, but with crypto, you really do need volume to go higher. The price is not going to grind slowly higher on less than average volume. Price is going to be a reflection of how much volume and liquidity is in the market as it grows and expands and gets bigger in an exponential way. It's kind of how network effects work. So today I want to just talk a little bit about fear because we are now officially 100% up from the COVID lows. So if you bought the bottom of the S&P 500 in March of 2020 and you sold today, you would have netted a 100% gain. And so a lot of stocks have seen over 100% since then. Amazon, Apple, a lot of blue chips even. I probably would guess McDonald's, Walmart, some of those as well. But to see an entire index go from one end of the spectrum, complete fear, to 100% in about a year and a half is pretty phenomenal. There's no real comparison to other times like it where the market has really doubled in such a short period of time. I think you would probably see maybe the dot-com bubble and maybe some stuff in the 70s or back in the 30s after the Great Recession. It's a very fast time for the value of stocks to double in such a short period of time. And despite all of this, the fear and the greed index is still showing us that investors have a lot of fear. And so, to me, there's a couple indicators that show this. On their side, the 7 indicators that they use are, again, the market momentum, junk bond demand, volatility, safe haven demand, put and call options, and stock price strength, and volume and breadth. The indicators that all show fear are the bottom 5. The ones that show greed are the momentum and the junk bond demand. For me, market momentum is the most important. And I think it just goes to show you that these indicators necessarily don't reflect price. I think there was a point in which it did. I remember when the market was doing really well in February before the whole COVID drop, it was in the greed ratio, and then when everything dropped, it was in the fear ratio. But we have just been grinding new highs after new highs, and it's showing that investors are fearful, and that probably has a little bit to do with the type of stocks that people are in. Some people have commented that some of these big tech names are really the ones doing all the legwork in the S&P 500, and that most of the smaller stocks have not seen new highs. It's a possibility. But for me, the only real way that I think you're going to see any big correction of any sort is when we get one of these dip buys, we get a close to a V-shaped recovery, or we don't get a V-shaped recovery, and then we break the low. And so that's a bit of technical analysis there, but basically, I think the only way you can really say this time is different is if we have a dip buy and it turns out that the dip buyers are not profitable after a short amount of time. But as long as they are, as long as that pattern keeps continuing where the dip buyers are rewarded for plunging into the deep end, then I would be remiss to say that there is a lot of fear in the market. A lot of social media stuff can be exacerbated, and that's why it's really good to look at the bigger picture, look at the charts, look at what the Federal Reserve is doing, expanding their balance sheet, and figure out if there really is fear. Let the analytics and the statistics and the facts show you, not social media. Secondly, we're going to talk about a story that just broke this morning, which is really interesting, but people have been talking about for a while, and that is these U.S. listed stocks getting clamped down on by the government of China. And so this week it was, and there's been some headlines over the past few days and weeks about this, but it kind of came to a really big head this week. This week it was all about U.S. listed stocks in the private education sector in the States. And so I'll read a bit of this article to you guys. 2 U.S. listed Chinese education stocks plunged Friday after reports of a government crackdown on the sector included bans on foreign investment. So TAL Education and New Oriental Education Technology shares both dropped by about 60 to 70%. This article is actually a little bit old. Basically because Chinese authorities have stepped up restrictions in recent months on the education industry and have kind of prevented now overseas and foreign investors from investing into these companies. So the big news is that so many of these Chinese companies have IPO'd or they've launched onto the NYSE and the NASDAQ. I think probably the biggest success story I can think of is NIO, which has kind of been seen as a Tesla competitor, and that stock went from I think $2 to $40, and they've really grown their offerings and things like that. And a lot of other companies have come to kind of that are native to China have come to get U.S. investment capital because U.S. investors are always looking for something new because bonds aren't returning the greatest, and U.S. equities maybe get boring, and it's good to diversify. The problem is the Chinese government has proven time and time again that they can come in and change the dynamics of the companies that operate in China at any point. They can prevent foreign investment, they can restrict them from operating, they can take their apps off the App Store in a moment's notice. And that's why I really can never invest in any of these things long term. I will trade them. I'll never own one of these stocks long term because, again, you really don't know what is going on with the Chinese government and whether or not they're going to turn a cold shoulder day in or day out. The other element to this story, too, is that Chinese companies have not had the strict accounting requirements in terms of transparency that U.S. companies have, yet they are able to list in the U.S. And so that is coming to a bit of a change, but it basically means in the next 3 years, every Chinese company is going to have to provide, I believe, an audit if they want to remain listed on the NYSE and NASDAQ. And again, even in the U.S., that can change as well. The difference here, obviously, is that these rules don't change overnight. There's a lot of bureaucracy and things that go into changing the rules of, what can be listed and what can't. I know Trump talked about, banning them at one point, but it's a lot of talk before action. And in China, it's action quicker than you can believe it. So that's what makes these stocks especially hard to hold. To dive into this a little bit more, in particular, these were Chinese private education stocks. Policy document approved by Xi Jinping circulated around Friday that has banned after-school tutoring businesses from advertising and says that they cannot operate during public holidays, weekends, and winter and summer vacations. So, yeah, I'd love to know the reason behind that. I don't know why you would ban education companies from advertising and operating during holidays and weekends, but it is what it is. But yeah, just on that note, I don't like to get caught up in those types of stocks for sure. So I have an article at the end that I'll share, and it's more of an opinion piece, but it's a really good look at the macro of what we talked about as kind of the theme binding all these stories together this week. So we'll go to the crypto stuff right now and kind of talk about what happened this week. So there were a couple events, but one of the more important ones was BlockFi coming under fire. And so if you don't know what BlockFi is, it is a company that offers Bitcoin loans and Bitcoin savings accounts and other cryptocurrencies as well. So you can take your crypto and use it as collateral to generate loans at a fixed interest rate, or you can use your crypto and lend it out to BlockFi as the custodian and get paid anywhere between 2 to 8%. And so these are regulated to some degree, but they are advertised and treated and spoken as such as savings accounts. And so BlockFi in particular is coming under fire because they are calling these things interest savings accounts. And so you have basically the New Jersey Bureau of Securities issuing a cease and desist order against BlockFi, claiming that it is some type of security offering that they have, demanding that it stops offering interest-bearing accounts and stops taking new customers in New Jersey as of Thursday. And then you have other places like, I believe Texas is starting to clamp down on them too, and Alabama. The BlockFi CEO, Zach Prince, has said that its accounts are lawful and appropriate for crypto market participants, and he added that a BlockFi interest-bearing account is not a security and that it will fully remain operational for current clients in New Jersey. The state's order targets BlockFi's high-yielding crypto accounts. Investors can buy a currency such as Bitcoin and deposit it in the BlockFi account, where it earns interest paid monthly in crypto, well above yields on traditional banks or brokerage deposits. BlockFi pools the deposits to funds its lending operations and proprietary trading. So again, one of the reasons they offer these great above market yields is because your funds are being lent out to parties that are involving themselves in riskier trades. And it's kind of like the bond situation where the government will give you 1% and government is almost always going to pay you back your money. But if you want, you can buy bonds from corporations, sometimes called junk bonds, which pay a bit higher but are not necessarily guaranteed to be paid back as well. So the more risk, the better the yield. The main point on this is that a lot of these savings accounts, whether it's BlockFi, Celsius, or another one, they can't be insured traditionally because you are taking counterparty risk in order to generate these yields. I believe Coinbase, if you have US dollars, they can back up those assets with federal deposit insurance, but I believe that is only for US dollars. And then there's also Securities Investors Protection Corp. There are not really protections for protecting crypto assets. There will be things in terms of insurance if there are things like hacks, but if a company goes bankrupt, due to their own faulty financial practices, that money can't be insured. That's kind of the risk that you take investing in these things. And so I feel a little bit bad because I made a video a couple weeks ago or months ago, basically telling people, look, this is an option if you want to generate yield on your crypto. But I did specifically say only put in as much money as you're willing to say goodbye. And while none of these platforms have been compromised, the rates and the yields have come down significantly to the point where I don't think it's really worth the risk to be putting in any amount of capital. I think now BlockFi, if you have over a quarter of a Bitcoin, they're only yielding 1.5% a year on your asset. And to me, to lend out your Bitcoin, which is a piece of property, and give it to someone else with all that counterparty risk just to get 1.5% is not really worth it. You can make that much on a good trade. And there's other platforms that are offering more competitive rates than BlockFi too. So talk smack about BlockFi. Don't use these platforms. It'll be interesting to see what regulations and kind of lawsuits come down on these if they're really going to move forward on them. But, it echoes this kind of feeling that I've had is that a lot of people will look at crypto as kind of this different way to diversify their portfolio. Like, oh, I'm going to have, some stocks, I'm going to have some bonds, some gold, and some crypto. But crypto in of itself is kind of its own ecosystem. And you can look at the asset class of crypto as, the default holding and entire portfolio that a lot of people actually have. And they want different products within there. So a crypto portfolio will have, maybe Bitcoin and some smaller altcoins, but it'll also have yield-bearing accounts. You might have NFTs in there. That's like collecting rare art. So there's different ways to look at it, and some stats on this too. It's like a parallel financial system, in my opinion. Around 35% of millennial millionaires have at least 50% of their wealth in cryptocurrencies. And I would probably say I'm definitely up past that 50% threshold myself. So everything in that space, in the crypto space, is going to work parallel to the regular financial space. Demand for yield goes up. There's this 60-40 rule with portfolios where if you're running a stock portfolio, you have an investment manager managing your money, they're going to put 40% of it in government bonds. That's government money that you're loaning out to the government for 1% return, and then 60% into equities, and that'll be stocks and high risk, low risk, blue chip, dividend paying, just any type of equities basically. And crypto is kind of creating their own version of this, I think, to some degree. So in the future, you might be buying some type of stable coin and keeping that in a crypto bond or crypto interest-bearing account. And that might be 40% of your capital will be some sort of stable coin that you're getting interest on. And then the other 60% might be this whole variety of different altcoins. So when you think of crypto more as like a parallel financial system rather than just another asset class to add to your portfolio, everything that's going on that is developing on a fundamental level starts to make a little bit more sense. So let's talk about the one reason that Bitcoin was actually not dumping this week. And that was because there was a conference called the B Word. And I'll link that down below, but essentially a Square Crypto, which is kind of a subsidiary of Square, which is run by Jack Dorsey, who's also the CEO of Twitter. They hosted this conference to kind of combat some of the misconceptions about Bitcoin, and I highly recommend watching it. They break down things like why Bitcoin mining is actually really green. Bitcoin is not used just by criminals, and in fact is a lot less friendly for criminals if they want to launder money. They debunk a whole bunch of thoughts that people had about crypto, but the biggest headline out of that whole conference was that Elon Musk joined Cathie Wood of ARK Invest and Jack Dorsey live to kind of talk about cryptocurrencies and share their perspective about how it can be used as an economic tool for economic empowerment. And so the whole conversation, I think, was about an hour and a half with that panel, but there's a lot of other great stuff on there as well. But some of the surprises, just to kind of recap it for anybody who doesn't want to watch the whole hour and a half thing, in my opinion, the biggest news was Elon Musk doesn't seem to be a Bitcoin only maximalist, not even close. He believes that there's room for multiple cryptocurrencies, and he announced that he owns Ethereum, and that's kind of news to the market. The Ethereum price definitely spiked during the conversation, but that's really interesting. And to add on to that point too, they didn't talk a lot about Ethereum because the conference was focused on Bitcoin. But Ethereum is kind of becoming the institutional cryptocurrency of choice as well. It's really cementing itself as the second place thing and something that a lot of institutions can invest in. And part of that, and whether you agree with how Ethereum runs or not, is the proof of stake algorithm and how that doesn't require miners using electricity to basically maintain the network. Cathie Wood was talking about ESG, which is environmental, social, and governance goals. And basically, a lot of companies will invest in one thing or another based on what their ESG score is. And so that score is made up of how forward-looking is this investment or this company in terms of helping the environment, how are their social policies, inclusivity, things like that, and then how is their governance, who makes up their board, who kind of runs the whole system, what are those people or places look like. Ethereum on an ESG standard is a little bit more friendly, some might say, than Bitcoin because of the environmental aspect and because it is proof of stake. So that's an interesting point, and it probably is a reason that Elon Musk might be investing in it, and Cathie Wood kind of has looked at it too at some point. SpaceX also owns Bitcoin. That was another piece of news. Some people kind of thought that because they were part of MicroStrategy's conference a couple of months ago back in February. But that's interesting to know that multiple of Elon's companies own Bitcoin, and he does himself personally. And then the other point too, and this is maybe not a big headline, but I liked it, is that Jack Dorsey hopes that Bitcoin can bring about world peace. And I really like this, and this is kind of what drives my whole belief in Bitcoin, not just as an investment, but as kind of like a social and philosophical investment as well. And that's basically that Dorsey was talking about how if Bitcoin was invented before social media, every social media platform would have adopted it. It came at a good time, obviously, after the 2008 recession, but there has always been this demand for a global, a native internet currency, because basically, whenever an internet company wants to launch in a new jurisdiction, Canada, the US, and Europe, and China, it has to go through currency controls and currency boundaries in those countries. And so it makes it very hard for certain companies to scale. And if people want to get paid in certain things, let's just say, creators on different platforms, you have a bunch of people watching in India and they're paying with the rupee, or in China with the renminbi. It's really difficult because there is no type of world coin, Bitcoin standard that everyone can use. And so his point was that if it came earlier in the life cycle of the internet, it would have been ubiquitous by now at this point. But he still believes that we are going down that path eventually. It would mean that there'd be less barrier to entry using a universal currency, taxation standards as well. People could earn in Bitcoin if it was regulated as something like that. And more importantly, world peace and this whole idea of like Bitcoin helping with world peace comes from the fact that money is basically money is just the government's monopoly on violence in a certain region. If you want to debase a currency and you don't want to, accept it or use it in trade, you better be ready to fight a war. And so the US has used their monopoly on violence to kind of perpetrate their dollar across the world. If you look at the countries that have had the reserve currency, they've all had the most powerful militaries. There's no, coincidence with that. And so basically, Bitcoin can exist. It's a working financial system, and it can be built on top of with layer 2. It can bring this type of non-state controlled currency to everyone in the world, and that really changes the dynamics of geopolitics. And I think that's something that Jack Dorsey has kind of addressed here. He said that my hope is that it creates world peace, or helps create world peace. We have all these monopolies off balance, and the individual doesn't have power, and the amount of cost and distraction that comes from our monetary system today is real, and it takes away attention from the bigger problems. All these distractions that we have to deal with on a daily basis take away from those bigger goals that affect every single person on the planet, and increasingly so. You fix that on a foundational level, and everything above it improves in such a dramatic way. It's going to be my hope. It's going to be long term, but my hope is definitely peace. And yeah, I would say that I agree with that. One of the things I'm really looking forward to is in September. That will be when El Salvador officially recognizes Bitcoin as legal tender. And we'll be getting data live out of El Salvador to see really what type of impact it has economically. Are people saving in it as a currency? Is the net worth of the average El Salvadorian rising year over year? People are going to see very quickly if that experiment works. And like all things, nobody wants to be the first, but when it works, nobody wants to be the last. And so if it works, I see a lot of third world countries adopting it, and that's just going to make it harder for first world countries to keep denying its existence, as they have been trying to do for quite a while, or making up stuff about it as well. Last question, or last part here too, is there's a couple more. One of the things that was also discussed in the whole B word conversation was that Bitcoin mining isn't nearly as bad for the environment as it used to be. That new data has shown, and that's mainly because of all the mining in China. The coal plants that might have been running Bitcoin mining rigs have all basically shut down, and about half of the world's Bitcoin miners were shut down in that process, basically overnight. And so all of these different mining operations, if they weren't destroyed, basically moved to other countries. I know a lot of mining moved to Kazakhstan, a lot has moved to the US, and these other countries, these people are basically looking for the cheapest sources of electricity, which happen to be renewable energy resources, to run Bitcoin mining. And in addition to this, one of the other things that's really important to understand about Bitcoin mining is that there's no other thing that you can create by diverging energy that can kind of be done anywhere. So energy is needed to make all sorts of things. It's needed to run, foundational plants, to create commodities, to mill lumber, to do all of these things, but it only works in certain locations. So I can have a waterfall running, but it's in the middle of nowhere where I don't have that resource that I want to divert that energy into. I have to build these long power lines and this long power grid to get that energy over to some place where it'll be useful. And so this term called stranded energy exists all the time, where you'll have certain things like methane flares or waterfalls in the middle of nowhere that are generating all this energy, but it is too expensive to divert that energy into a local town to make it worthwhile to build all that infrastructure. Bitcoin solves this because basically, as long as the Bitcoin network is operational and there's a demand for Bitcoin, you can take basically a steel container full of Bitcoin mining rigs and just bring it virtually anywhere, by helicopter, by truck, and set it up next to this power source. So you can set up methane capturing power plants, or you can run a dam off of a waterfall in the middle of nowhere. And you bring your Bitcoin mining rigs with you, and you can essentially generate something from that. You can use that energy to generate finance, and that can be diverted into all sorts of things. This is really, really important for a lot of third world countries, which are really flush with energy resources, but do not have the economic incentive to actually distribute that energy to other points. El Salvador, for example, has very cheap energy because they have volcanoes there. So they have a lot of geothermal energy. They have steam plants coming off, and they capture that. And it's more than enough for their population. But if they want to send it north or south or east or west, to build the power line to distribute it, and all the power that gets lost in that process kind of makes the whole process not worth it. But now that they are adopting Bitcoin and are really pro-Bitcoin, they can use that stranded energy to develop and create something through Bitcoin mining that will actually be of use and will help the economy in this country that has been under the pin of the U.S. for so long. Last story about Bitcoin here is, while the Bitcoin price has not been that exciting, there are people who are buying right now. And this is something that I mentioned in the last video as well, is that there are a lot of ways to get exposure to Bitcoin right now where you can get a lot more bang for your buck than just buying spot Bitcoin off of an exchange. And so I mentioned there's the GBTC arbitrage, where you can basically buy a Bitcoin through GBTC and essentially be paying about 28,000 versus it costing about 32,000 right now. But you also have these miners, and because of what I've just explained going on with Bitcoin and now how mining is yielding a bit more because the hash rate has gone down, these miners are going to have record-breaking quarters for Q2 and Q3 because they're going to be they're going to be getting so much more of the block rewards that are created in this time span. And so you're seeing a lot of investment funds invest into some of these other proxies for Bitcoin. GBTC ARK Invest just bought $30-40 million worth. Rothschild Investment Group just bought $7 million worth, and now you have pension funds investing directly into these miners. And that's for two reasons. One, that buying Bitcoin is a little bit tricky from a regulatory standpoint, as it's kind of this intangible asset. And two, some of these things like the miners and GBTC are trading at such a discount to actual Bitcoin that if you believe Bitcoin's going to do really well over the next year, the miners and GBTC are going to do even better because they're basically just a leveraged version of that may or may not be trading at a discount. All right. So last story here, and we'll wrap it all up. This is a really great article written by Arthur Hayes that I'll go over here in just a second. Fiat money also allows massive deficit spending to fund wars, which would not be fundable otherwise. Yes, this is a really, really good point. And it benefits the nation that has the reserve currency because they can essentially print, and what are you going to do about it, right? We're going to talk about this in this article in particular because there are three major economies, not just the US, that print money and are doing very similar things with their monetary policy. And that is the US, China, and Europe, or the ECB. This article here was written by Arthur Hayes, and I'll share it down below, and it's called I'm All Shook Up. And it's basically, Arthur Hayes is the founder of BitMEX, which is a crypto derivatives exchange. Basically, every summer is the fucking same. When crypto hits the northern hemispheric summer, people lose their bearings. Price volatility wrecked, price performance wrecked to sideways. Exchange trading volumes abysmal, crypto trader sentiment despondent. Accurately summarizing what we've all been through in the last 2 months in the cryptocurrency markets. Staying focused on what matters becomes increasingly difficult as we are bombarded with data through our internet-connected devices. There is always some piece of information that can cloud our minds, but those who are focused care not for the vicissitudes of the 24/7 social media dopamine distributing news cycle. They only analyze what they believe is the key driver of financial returns. And zooming out, I'm only focused on one piece of macro data, and that is the pace of central bank balance sheet expansion. If the quantum, the supply of money increases, it must go somewhere. Crypto, alongside stocks, commodities, housing and bonds, etc., will all receive the manna from unelected bureaucrats. Let's take stock of what our monetary masters cooked up for our financial well-being in the first half of 2021. The three central banks that matter are the US Federal Reserve, the People's Bank of China, and the European Central Bank. Combined, these three entities pump the lion's share of fiat wampum into the arteries of the global economy. These central banks also represent the largest economies in the world. Here is my simple checklist for my simple investor brain. Is the money supply as defined by the central bank balance sheet or gross credit issuance increasing or decreasing? And at what rate? What financial assets do I need to own to outperform the growth of credit? Is the reference government bond rate below or above nominal gross domestic product growth? And if bond yields are lower than GDP growth, then you have to find financial assets in the hopes of not suffering a negative real interest rate, or else I should own nothing else besides government bonds if they're doing better than GDP, because why would you take a risk at all if your savings are going to be growing at a positive rate and helping you gain purchasing power? So let's break this concept down a little bit. And there's some confusion here between basically real yield rates versus nominal interest rates. And I'll kind of break down what these two things are. So the return of an average bond is basically specified on how, okay, let's just break down one thing at a time. A government bond is basically the government borrowing money and paying back a interest rate of anywhere between 0 to 12% historically. So you buy these bonds, you're giving the government money at the end of the term of a bond, whether it's a 2-year bond or 5-year bond or a 10-year bond, they give you a posted rate. Right now, the interest yield on a 10-year bond is about 1.2%. So if you lent the government about $100, in a year or so, you get paid back about $101.20, which is not so great. Now, there's something called a real interest rate. And basically what this is a calculation of is the yield of a bond minus CPI or inflation. And what that number gives you is basically the purchasing power every year of an asset that is a bond. So let's give an example here. A bond from the government, a 10-year yield, gives about 1.2%. And the CPI is about 5.5% right now. That was the latest numbers that we're going through, about 5.5% inflation annually. So 1.2% minus 5.5% gets you around negative 4.3 or 4.4%. So what that basically means is that if you buy the safest asset there is in existence, and that is a bond, that is a guarantee from the government, and the government almost never defaults on their bonds in the US. If you buy a bond, every year you're losing about 4% of your purchasing power. If you just held cash because of inflation, you're losing about 5% of your purchasing power, which is worse. But even if you're buying an asset, which is better than owning cash, you're still losing money on one of the most popular assets ever, which are government bonds. So the nominal rate of a bond you might think is, okay, I got $100 and that will be worth $101.2 next year. But the real rate measures purchasing power. And so if your negative real rate is about negative 4%, that means $100 worth of your bond this year only buys you about $96 worth of something next year. So that bond that you have, yes, it might be getting a little bit of interest, is still not a good allocation of your capital because everything else is rising a whole lot faster than your bond. And so we have had these things called negative real rates, and that's what this is basically, a negative 4% real rate in the government right now. we've had these negative real rates for basically since the Great Recession back in 2008, because the government started this program, quantitative easing, where they were buying government bonds to issue new money into the money supply. And so that has basically meant that you will be losing purchasing power in cash, and you will be losing purchasing power with bonds. And the only way to really have more purchasing power every single year, to buy more things like houses and things that inflate in value, is to buy an asset that is generating marginally more than inflation. So if you don't own things that are going up by 5% a year, you are losing money. And this is a concept that a lot of people in lower classes don't understand, because they're fixated on wages and saving. And the most important asset that people kind of strive to own is real estate. And real estate, of all assets, is one of the best performing ones. It's been going up 10, 20. I mean, it depends where you live. In Vancouver, it's going up 20, 30% a year. So there's very few things that are going up 20 to 30% a year. The stock market, for example, goes up about 8% a year, the S&P 500. So if you want to avoid negative real yields, the stock market's a good place to put it. Real estate's a great place to put it, even better. So going over a little bit more on this is, when does this negative real yield rate conundrum that we're in stop? Because it's been going for an awfully long time. Well, the Fed basically says there are two ways that will change this, and that is because they control the interest rates, they can kind of control the risk to some extent that investors take. And so they have a mandate, and their mandate is basically prices and unemployment. They want to make sure that inflation is under a certain amount, but they also want to make sure that unemployment is very, very low. However, the unfortunate thing is that the Fed's policy responses do not correlate at all with changes in these variables. If the Fed wants to print more money, all inflation is transitory, temporary, and all jobs are not enough. There's not a low enough unemployment for them to say, look, we don't need to keep printing money. If the Fed wants to tighten, then all inflation will unanchor expectations, and we are at the magical but numerically undefined full employment. The data can be twisted to meet whatever the priority policy response is. In his previous piece, he argued that the Fed, and every other major central bank for that matter, has been tasked to monetize its domestic government's debt issues to pump up the economy in the wake of COVID. Until growth is achieved, they will continue to print whatever is necessary. The Fed cannot directly admit this, as that would exacerbate the already astronomical Fed put, and that is that if the market is defined by stocks, and if that declines, then the Federal Reserve must rescue the market with more printed money. So this is a really important thing to realize, is the Fed has themselves in a bit of this circular bind where they have to pump money into stocks. They have to print money. They have to be the buyer of bonds. They have to keep this negative real yield going as long as possible, because it helps monetize the government's debt. And so this chart kind of breaks it down a little bit, but to summarize, the top 5% of all households in America, the top earning households, top 5% in America, pay 60% of the income taxes. But these people in those households are generally not making most of their income from wages, from salaries. They're not doctors making, a bundle of a fixed salary here, or a lawyer making a fixed salary there. They own corporations, and they're building their wealth through other instruments that are being propped up basically by the Federal Reserve. So therefore, if the Fed does not help the stock market and the value of these assets come down, then the amount of income that is being generated by the top 5% isn't as high. And that money in spite is not going directly into the government. So essentially, if the Fed does not prop up the stock market, then it harms the US government and the net income of it. So there has to be a buyer of the bonds, there has to be a payer of the taxes, and that means that people have to be making money through investing. And if they're not, then the amount of money that the government gets every year to pay for all the things that it has to pay for, it says it has to pay for, goes down. Look what the Fed is doing rather than what they are saying. Every week features some Fed governor talking some nonsense about how the Fed will respond to certain economic outcomes. He goes into a bit more data here, but essentially to summarize, the US 10-year yield is really, really important because it measures essentially the base interest rate of a bond. And a bond right now, 10-year yield is about 1.2%. And basically, the Fed is the buyer of last resort of these things. So that is the benchmark that controls half the equation of what the real yield is. Just going down through here. And so the Fed is not the only purchaser of bonds. Obviously, a lot of pension funds and investors are buying these things as well, but they're buying about 20% of them. So let's go through one of the Treasury reports here, what he mentioned. Year to date in 2021, foreigners did some bond math, and they net dumped $39 billion of bonds and purchased $42 billion of equities. So not only do they have to pump up the bond, they not only have to pump up equities to help Americans, so the Americans, the top 5% are making enough to pay taxes to fund everything. It's also helping foreigners as well who finance the US government and also hold equities. So money printer go burr not only helps wealthy Americans, it also helps wealthy foreigners. As a Canadian, I can agree with that. The political setup for the Fed to continue printing $120 billion per month is perfect. And guess what? The data clearly shows that they are staying on message. Let's answer a question about the status of the US monetary system. The Fed's balance sheet, how much they've been printing, has expanded at a year-over-year pace of 22% and a year-to-date pace of 13%. Have you outperformed? Bitcoin year over year, 229%. Ethereum, 663. Bitcoin is now negative for the year as of the writing of this article, but we know that can be temporary perhaps, but Ethereum is up 150%. The current forecast of the US GDP is 6.6% versus the US 10-year yield that yields about negative 1.2%, which roughly yields a negative real yield of negative 5.4%. So we've set the stage here. The US has this monetary policy. They have this net real yield. And of course, if you've been doing any sort of investing, you know this, that there's no point in holding cash. There's no point in having a savings account. There's no point in having bonds. You got to be in risk assets if you want to make any money and you want to increase your purchasing power. You got to be in real estate. You got to hunker yourself to some sort of thing. Even gold doesn't seem to be working that well in the face of all of this. So you got to hunker yourself down to riskier and riskier assets to increase your purchasing power and your quality of life. Now, what are other governments doing? Remember China? That's funny. So China is also in a little bit of a similar situation. However, they have been given the credit of being a little bit more restrained. So estimating the growth of credit in China is an art rather than a science. There are so many conflicting statistics that a euphemism called total social financing was created to encapsulate all the various ways credit is pumped through the economy. The Bank of China calls it the China All System Financial Aggregate, and as of June, their metric for the balance sheet expansion is around 11% year over year. Given that China has the largest debt stock in the world, that is an absolutely stupendous amount of renminbi. To be exact, in 2021, China expanded its credit stock by $2.74 trillion. So the PBOC officially has only expanded its organization balance sheet by 0.2%. This is why some people believe China has shown restraint in the face of COVID compared to its US and European counterparts. Beijing has many ways to skin a hog, and credit is often created through commercial banks on and off balance sheet lending. Even though the $2.74 trillion is not a central bank figure, the PBOC is at the table when it decides who receives credit and how much. Rather than list a bunch of acronyms for various government bodies involved in rationing credit, I use the PBOC as a familiar placeholder. All credit in China is de facto state-controlled. The banks that create credit and the companies that receive it are by and large all state-owned. That is why I use the total credit figure in China and not a similar metric in the US or Europe, where bank credit creation is administered by private companies to earn a profit. So the big difference here essentially is that their balance sheet has not expanded as crazily as the US, and that their credit is state controlled. So the government has a stake in all of this stuff. It's very, very much centralized there. So their system of credit is similarly under control. However, they also have a negative real yield in China as well, because their year-over-year GDP print is around 7.9%. And then essentially what that means is that they have a negative 5% real yield in China. So even Chinese investors are not incentivized to save money in a savings account. Chinese investors also are going to equities and going to real estate. And, you know, there's a lot of talk that Chinese investors are fleeing the country, but you're able to make money and, you know, create value very easily within China as well, outside the capital controls. Lastly, let's talk about Europe. Very similar with balance sheet expansion. So the ECB prints money. They've expanded their balance sheet by $1.1 trillion so far in the first 6 months, year over year, 25%, year to date, 13%. So a little bit more than the US. But one of the different things is that their yields are so low, and they're really, really pushing and incentivizing people to spend money, that the 10-year bond yields in Germany are negative 0.4%. So if you lend the German government $100, you can expect to get $99.6 back in a year, and it keeps getting worse. but the Germany GDP is expected to print about 4.5%. So their bond yields are worse in Europe, and their GDP is also worse in Europe than in the US. But essentially, all of these things have more or less the same negative real yield, and that is that if anybody is holding cash, anybody is holding bonds, they're losing money. They're losing not money, they're losing purchasing power. The money is relative, but the purchasing power is going down at a rate of about 5% every year, whether you're in the US, whether you're in China, whether you're in Europe. So in totality, the three strongest economic countries and regions globally all engage in rampant money printing. All real yields are negative. While people focus on the month-to-month rhetoric regarding when the printer will stop printing, the central bankers continue to expand their balance sheets. Don't let the noise fool you. If your investment thesis is in crypto, equities, properties, and is based on fear that your financial assets must keep pace with the expansion of central bank balance sheets, continue being fearful and accumulate. $4.72 trillion of money that is created out of thin air has to go somewhere. The challenge is to procure the assets that will receive a slice of these funds. Investors who come out on top will be the ones that do not fall prey to the economic sophistry of believing long government bonds owned at the zero bound will save their portfolio from the ravages of negative real interest rates. So, I know it's hard to stomach the 50% drawdowns from all-time highs in Bitcoin and Ethereum. If you own DeFi coins, you were wrecked. However, sell when you want to, not when you have to. And that comes down to position sizing and using leverage and getting insurance. So channel your inner Soros, observe, don't predict. The data is clear. Central banks continue to print money. When and if that data changes, the data will show us. There's no need to predict when it stops. There's no need to predict what the outcome of all of this is going to be. If you own scarce assets that appreciate in fiat terms, at least at the same pace of balance sheet expansion, on the 6-month horizon, crypto underperformed, but from the onset of the COVID pandemic till today, the crypto market and all markets have outperformed as central bankers stepped on the gas. Don't get shook. So, again, to reiterate, don't get shook. That's really what it's all about. And so this week we had our big correction. We have China doing this. We have, details, China bans mining, China does this. China's a big part of all the hysteria, it seems, in the crypto space as of late, and the central markets to some degree. Don't get caught up in the noise. If the central banks are printing money and the real yield is negative, the most capital in the world is going to go into equities. And when that changes, you'll know. The market will react to it and you will have time to get out. But you're not going to lose all of your savings in a day. You're not going to lose all your purchasing power in a day when that decision is made. Adapt to situations. And if you're really nervous, buy insurance and hedge against it. You can short bonds through puts. Those give you outsized leverage if bonds go up in yield. And there's a lot of different ways to approach this. Maybe more complex strategies than for most people. But if you're watching this and you've listened to me yammer on for 45 minutes here about central bank printing, then the simple takeaway from this is that own assets that are doing better than 6% a year in nominal returns, and you will be outpacing the negative real yield. So whether that's crypto, whether that's stocks, invest in things that you believe in, invest in things that have track records, invest in the future. That's why the tech stocks have been doing so well, and you really can't go wrong, and you will have more purchasing power coming out the end of this compared to not. And that's my lesson for today, as confusing as that was. So that's it. So let's jump into some of the Q&A here, what people were kind of talking about. Oh, awesome. We got up to 12 viewers today. That is sweet. So thoughts on Bitcoin. What's going on here? Stocks and bondage. You know what's funny? I don't know. I mean, I'm in the chart, guys, so I know the trading group there, but I don't know anybody who owns bonds. I guess you can have exposure to it by owning companies that might own bonds or issue bonds, but owning a bond is just like having a savings account at a bank. Like the yield is, maybe a little bit lower in a savings account, but people do GICs. They do all these different, like, really low returning things. I know my dad was talking about, getting to a GIC, getting 1 or 2% in like a 90-day or a 180-day term. And I just thought, like, there's no point really. Like, what does 1% difference make opposed to just holding cash? And then you actually have the flexibility to do something with cash, right? So it's a hard environment. It's one of the reasons that meme stocks have gone awry. Everyone thinks, oh, it's just a bunch of retail investors. It's major hedge funds are investing in these things too because they see the potential to generate capital through them. They can follow the crowd. But they also know that, social media has network effects. And so these stocks like AMC and GameStop are affected by these growing bases of basically traders that are getting into the market and people who are wanting to grow their capital rather than just, go paycheck to paycheck and watch the value of that paycheck diminish year over year. So meme stocks, I think we thought they were an anomaly, but when you really look at the bigger picture, it's almost like they were inevitable. Maybe it's easier to say that now in hindsight, but it feels to me with what is going on with the macro picture that a lot of this stuff with meme stocks, with crypto, with all Doge, whatever, it's just inevitable. People are looking for yield. They know their money is losing value. The appetite for Dogecoin and Bitcoin investments will drop significantly if your savings account can give you 5%. All these people that are in the stock market right now cut a good chunk of them out if the savings accounts actually ended up paying a good amount. So yeah, that's it. That's the show. No giveaway today, but I'll do one next time. I'll give away $10 of Bitcoin. The two lovely people who won Bitcoin last time asked me to give it to charity, and I've done that. I give it to one of the foundations here for I think disaster relief. But come prepared with some knowledge next time, and I want to actually give some cash to one of you guys. Charity is good too. I'm always happy to give it to charity, but it would be nice if one of you guys walked away with 10 lovely dollaroonies in Bitcoin, and maybe that'll inspire you to start a Bitcoin wallet as well. Thanks so much for watching. Take care, and I'll see you all next week. If you have any questions about any of this stuff, if any of it didn't make sense, I'm always open to feedback. Leave it down below, and I'll always engage in conversation in the comment section as well. Take care. Have a fantastic weekend. Hopefully it's sunny and not too smoky where you are. And yeah, catch you next week.